MicroStrategy.
MicroStrategy. Now, here's the kicker before we get into it.
Every long investor in MicroStrategy is a Bitcoin maximalist or Bitcoin believer. They've accepted that risk.
What if I were to tell you that one of Bitcoin's greatest existential threats was also one of its biggest champions? Now, at first glance, this company looks like Bitcoin's most loyal ally, and that may hold some truth. After all, it holds more Bitcoin than any other publicly traded company in the world.
We've got $35 billion of Bitcoin, and it's spinning at 100 ball.
And its founder is one of the loudest Bitcoin maximalists out there. Furthermore, for years, its strategy of buying Bitcoin has been praised as a masterclass in conviction. But if you look a little closer, the picture starts to change. Because this isn't just a bold bet on Bitcoin, it's a strategy built on leverage, fueled by debt, and entirely dependent on the assumption that the price will keep climbing and new money will always be there to sustain it. But if that flow slows down, or worse, reverses, the entire structure could start to crumble. This company is none other than MicroStrategy, now rebranded to Strategy. And today we're going to be breaking down why their Bitcoin obsession may be setting the stage for one of the most overlooked risks in the entire crypto market. From debt exposure to liquidation thresholds and the cascading effects a crash could trigger, this is a risk few are prepared for, but that no one in crypto can afford to ignore. If there's one company that's gone all in on Bitcoin, it's definitely Strategy. Since 2020, the company has transformed from a modest enterprise software firm into a corporate Bitcoin whale, accumulating over 530,000 Bitcoin and holding more of the asset than any other public company on Earth. To put this into perspective, that's roughly 2.5% of the entire supply of Bitcoin taken off the market and locked onto their balance sheet, and about half the total supply that Satoshi Nakamoto currently holds as well. Their average purchase price around $66,000 per coin, although it was much lower just a few months ago, around $31,000. With Bitcoin now trading far above that level, on paper the bet looks brilliant, as its founder Michael Saylor looks like a visionary. With billions in unrealized gains, the market sees strength. But what's made this strategy so bold isn't just the amount of Bitcoin they've bought, it's how they actually bought it. Since 2020, the company has raised more than $33 billion through a mix of convertible notes, secured loans, and private offerings, with each round of investment designed not to build the business, but instead to buy more Bitcoin. In simple terms, MicroStrategy, now Strategy, borrows money, uses that money to buy Bitcoin, and then holds it on their balance sheet as a core asset. At this point, the company's value moves almost entirely with the price of Bitcoin. So when you invest in MicroStrategy stock, you're not really buying into a software firm. You're buying a highly leveraged Bitcoin position in disguise. Regardless, while some of these loans they take out to buy Bitcoin come with generous terms like low interest rates and long horizons, others, particularly those backed by Bitcoin itself, come with far more risk if the market turns sour. Michael Saylor, the company's founder and CEO, has been the driving force behind all of this. He hasn't just embraced Bitcoin, he calls the asset digital energy, insists it's the future of money, bull posts on X and goes on podcasts to talk all about it, and has repeatedly declared that selling is not an option. After all, as a Bitcoin maximalist, this isn't a trade for him, it's doctrine. But even the strongest belief systems are bound by math, and while Strategy's BTC play might look invincible when the asset is soaring, it's a very different story if the price starts to fall, and that's where things start to get complicated. So far, Strategy's Bitcoin play looks bulletproof. The market's up, the balance sheet is green, and Saylor is still preaching. But the entire model hinges on one thing: Bitcoin's price staying above a critical threshold. Strategy's average purchase price sits around $66,000 per coin. But that's only part of the story. Some of their convertible notes don't mature until 2028, which gives them some breathing room. However, other debts are more fragile. For example is the $205 million loan they took out in 2022 from Silvergate Bank, which was backed by Bitcoin and triggered a margin call when the price dipped below 21,000. Now, while that loan has since been paid off, it exposed a key vulnerability. When your collateral is as volatile as Bitcoin, price drops aren't just a paper loss, they're a liquidity risk. That said, it's worth noting how MicroStrategy handled the 2022 bear market, which was a very rough one to say the least. For example, when Bitcoin crashed to nearly $16,000, the company didn't flinch. Better yet, they didn't even sell. In fact, they just kept on buying. That level of conviction earned them praise across the crypto space and proved they weren't quick to fold under the pressure. But holding through a downturn isn't the same as being immune to one. At the same time, interest rates were low and market sentiment, though shaky, wasn't as structurally stressed as it could be in a future crisis. If another deep correction comes while debt is more expensive and liquidity is tighter, the same resilience might not be so easy to maintain. So, where's the red line? Well, analysts estimate that if Bitcoin falls below $55,000, MicroStrategy could once again face pressure to post more collateral or sell part of their holdings, with insolvency being much more likely with a drop below $30,000. Nothing is guaranteed, but the deeper Bitcoin drops, the tighter the squeeze becomes. And if interest rates stay high or refinancing options dry up, that debt becomes harder to service, especially if their core software business isn't generating enough cash flow to support it. But the real danger here isn't just numbers on a balance sheet, it's sentiment. If the market even suspects that strategy might be forced to sell, the narrative flips. Investors pull back and panic sets in. And at that point, what was once a symbol of conviction turns into a potential trigger for collapse. Because if strategy starts bleeding, Bitcoin doesn't just lose a whale, it loses one of its loudest believers. And that kind of shift could ripple far beyond this one single company. Strategy currently holds over 530,000 Bitcoin, which, as I said earlier, is roughly 2.5% of the entire circulating supply. And in a market known for its volatility and thin order books, that's not just a large position, it's a potentially market moving one. If they were ever forced to sell a significant chunk of their holdings, whether due to margin pressure, debt obligations, or internal restructuring, the impact would be immediate and severe. A large-scale liquidation of that size would flood the market with supply, overwhelming demand, and sending the price into a free fall. Some analysts, like DataDash's very own Nicholas Martin, have suggested that Bitcoin could find a temporary floor around $30,000 in such a scenario, but only after significant turbulence. However, the overall damage in this potential situation wouldn't just solely come from the act of selling. Instead, there's a twofold problem here. First, the direct selling pressure would weigh heavily on BTC's price, but second, and arguably more dangerous, is what this would signal to the market. After all, strategy has become a symbol of institutional belief in Bitcoin, and if that belief wavers, even under financial duress, it could shatter long-term investor confidence. ETFs could see even more outflows, retail could start to panic, and long-term holders might start questioning whether Bitcoin's institutional movement is slipping away. In other words, it's not just about the coins that strategy would sell, it's about the faith they've helped build and what happens when that faith starts to crack. Now, if strategy ever stops buying or worse, starts selling, the question becomes painfully simple. Who steps in to absorb that kind of pressure? After all, institutional interest in Bitcoin isn't what it was 6 months ago. Many of major ETFs, once hailed as the next wave of mass adoption, have been seeing substantial net outflows within the last few months. Retail investors who usually rush in during hype cycles have been cooling off too. Search trends are down, engagement is soft, and even crypto Twitter feels quieter than usual. You see, for years, MicroStrategy has been the buyer of last resort. Every dip, every correction, Saylor was there to double down. But if that source of buy-side pressure disappears, the absence will be felt across the entire market. And in this situation, it's not just that no one is buying, it's that no one is expected to. And in a market driven by narrative, sentiment, and speculation, that shift could be brutal. While Bitcoin is no stranger to corrections, confidence is a currency of its its own. And when that dries up, price tends to follow. The bigger question isn't whether Bitcoin survives without strategy, it's whether the current market structure shaped by years of aggressive corporate buying can stay intact without it. Because when one player holds that much influence over a market, it's not just the price that's at risk, it's the entire foundation of trust. And if that sounds familiar, that's because it should. In the grand scheme of things, this isn't the first time Michael Saylor has bet big on a revolutionary technology, and it's also not the first time the outcome of that could define an era. Back in the early 2000s, MicroStrategy became one of the poster childs of the dot-com bubble. The company soared to a $20 billion valuation almost overnight, fueled by bold promises and speculative enthusiasm. But that momentum didn't last. After a series of accounting missteps and brutal market corrections, the stock collapsed. At one point, shares dropped by more than 95%, and Saylor himself lost billions on paper. Now, 2 decades later, the pattern feels eerily familiar. We're seeing what most view as a speculative asset embraced with near religious conviction, and strategy has become the face of a movement. And once again, Saylor is all in, except this time it's not with internet infrastructure, but with digital gold. Overall, the parallels between then and now are hard to ignore. Aggressive positioning, market euphoria, heavy reliance on leverage, and a growing chorus of critics warning that the numbers don't add up. Now, of course, history doesn't repeat itself perfectly, but it often does rhyme. And if the past is any guide, the line between visionary and cautionary tale can be thinner than it seems. It's worth noting that Bitcoin itself has become more resilient too. Every major bear market in Bitcoin's history has generally been less severe than the last. For example, in 2018, Bitcoin dumped around 84%, but in 2022, despite extreme macro pressure and cascading liquidations, the drawdown from peak to bottom was closer to 77%. Volatility is still part of the game, but as the market matures, the floors are rising, and so is the institutional adoption. So while the risks are real and the comparisons to the dot-com era are valid, the foundation beneath Bitcoin today is stronger than it's ever been. Which means if this ends in disaster, it won't be because of the asset itself, it'll be because of how it was used. At the end of the day, Michael Saylor and his company's Bitcoin strategy has become one of the most aggressive, celebrated, and polarizing plays in the entire crypto space. While on the surface it looks like unshakable conviction, underneath it's nothing more than a high-stakes financial experiment built on leverage, driven by narrative, and tied directly to a volatile asset. That said, if Bitcoin keeps climbing in price, strategy could be remembered as a bold pioneer. But if price reverses and debt obligations begin to bite, the company could become something else entirely. A pressure point capable of shaking investor confidence and forcing a painful correction. That doesn't mean Bitcoin is doomed, far from it. The protocol is still sound, the adoption curve is still climbing, and over the long run, it's survived much worse. But as we move into this new cycle, it's worth asking the question, has Bitcoin become too dependent on a single company's balance sheet? Because when one company holds over 2.5% of the circulating supply, that concentration introduces a new kind of systemic risk. It turns Bitcoin, a decentralized asset by design, into something that particularly hinges on the financial health and decision-making of a single firm. And while Michael Saylor's conviction has been unshakable so far, conviction doesn't erase debt. If the market turns violently and refinancing becomes impossible, or if regulatory or shareholder pressure mounts, there may come a moment where strategy has no choice but to sell, even if it doesn't want to. And if that happens, it won't just be a liquidation, it'll be a narrative collapse. One of Bitcoin's loudest believers forced to unwind in public. And in a space built on momentum, psychology, and trust, that kind of moment could do more damage than any hacker ban ever could. Because in a system built to resist single points of failure, what happens when the biggest risk is belief itself? But what do you guys think? Is strategy strengthening Bitcoin's long-term foundation or turning itself into its greatest hidden risk? Let us know in the comments section below, and don't forget to like and subscribe for more deep dives into the forces shaping the future of crypto.